Good afternoon and welcome to the Oakley Capital Investment Limited 2021 annual results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Stephen Tredget, partner. Good afternoon.
Good afternoon. Thank you, and thank you for those who have joined us for the OAKLEY Capital Investments 2021 full-year results presentation. I think, look, in summary, as I'm sure those that have seen the results will hopefully agree, we've seen two things: strong earnings and significant realization, and those combined have really driven a significant NAV growth in the year that's just gone. I think probably what's just as important for all of us as we look to 2022 and the uncertainty is looking ahead. What can we expect from the current 22 portfolio companies? And I guess the key message we're looking to get across today is that we think that performance can continue, and that we'll continue to benefit from a range of long-term trends across our three core sectors. So looking there at the numbers we published yesterday, based on the portfolio being fully revalued to December, the net asset value per share rose from 445 pence at June to 538 pence at the end of 2021. Now, this sustained NAV growth is delivering scale for OCI, and I think that's one of the kind of important things to kind of highlight here. Those that have been on the journey with OCI over the last few years have seen, consistent growth. And I think what's important for a vehicle like ours, where that comes to liquidity, presence in the markets, whatever it may be, getting up and over that £1 billion mark, I think is not unhelpful for the company. The 35% total NAV growth for the year, I think, hopefully speaks for itself, and we'll talk more on what specifically drove this and how our growth can be sustained in the year ahead. We have cash there of 163 million, which currently sits on the balance sheet and represents about 17% of NAV, and much closer to our long-run average of about 15%. This healthy level of cash and expected proceeds has enabled us to make another initial commitment to the recently launched Fund 5. Moving now to the ubiquitous NAV per share bar chart for investment companies, and it shows that kind of performance momentum building. And why is that? Well, I guess it's thanks to a number of things. It's an established portfolio, it's a large portfolio, it's a maturing portfolio, and it's an investment strategy that has become honed and focused over the course of since the first fund was launched in 2007. Our 5-year compound annual growth rate is now 19%, and it's one of the highest in the sectors, and in line with what we believe is repeatable in the years ahead. Let's talk about what has driven that NAV growth and the significance of that. So we look here at the bar there represents the kind of total growth in the portfolio companies, which is around about in value, which is around about 300 million pounds worth of portfolio value growth in 2021. And in short, portfolio company financial performance has been the key driver in that period, with 75% of that portfolio company growth being driven by increase in EBITDA by the portfolio companies over the year. The average portfolio EBITDA growth in the period was 28%, with the growth rate higher in the second half of the year, reflecting, I think importantly, that this growth wasn't based on a pandemic-related boost to our tech investments. That boost, and it did exist predominantly in the second half of actually of 2020, was not prevalent this year, and it certainly wasn't in our stronger performing second half of this year. We'll highlight some of the best performers over the slide. In turn, multiple expansion drove 25% of the value growth, and half of this was based on the realization of tech insights. The portfolio now stands at a conservative average EV/EBITDA multiple of 14 times. And we'll talk more on this and our confidence in these ratings shortly. The largest contributor to OCI's NAV, based on their financial performance, was first in the line there, IU Group, adding 52 pence to NAV. Now, as many of you will appreciate, the German-based university has an online platform that can deliver tuition of multi-topic degrees to people in work anywhere in the world. And it saw its student numbers move from 32,000 at the beginning of the year to now well over 80,000 at the end of the year. And the courses that it now offers kind of grew from somewhere in the region of 100, 120 to somewhere close to 200 at the year close. Secondly, there is Wishcard, which added 10 pence to NAV. Now it's one of the leading European gifts and rewards platform, and it saw sales grow by 70%, selling over 9 million multi-brand gift cards in the year, predominantly in Germany. I think pleasing for us is not just that the business recorded strong growth across all its business segments, but it was particularly impressive in e-commerce sales, which more than doubled versus last year. And then thirdly, Contabo, which has seen above budget demand for its web hosting services, which have continued to surge, and it led to a doubling of EBITDA in the year. Now, when it comes to multiple expansion, as we touched on, Tech Insights is the key contributor. For those that recall, Tech Insights is a technical content platform for silicon microchips. It basically tears down mobile semiconductor-led devices to understand and evaluate the IP and performance of those products. It then essentially sells that information, that knowledge to OEMs, kit designers, whatever they be, global players of that kind around the world. Its valuation was raised to reflect the signing of an agreed sale of a stake in that business to CVC in December. And the sale at 130% premium to the June book value reflects, I think, really three things. One is actually the kind of transformation, the quality of the company's earnings. When we bought that business in circa 2017, 20% of its revenues were subscription-based, i.e. it sold the information that it essentially mined from those devices predominantly on a project basis or one-off fees, and only a small amount of it was sold to subscribers. In the year just gone, it had grown that to 65% subscription. And it's clear that that shift in quality of earnings is one of the things that was reflected in the valuation uplift. It also reflects the discipline that Oakley adopts when valuing its portfolio companies. And thirdly, it demonstrates the continuing strong demand for our tech-enabled assets, particularly from the large global sponsors. Paying 14 times for 28% EBITDA growth sounds, I think you agree, pretty attractive. And if you look to last year, as a conservative rating in contrast to many of the tech growth stocks, which were arguably priced to perfection in 2021. But even after recent falls in the market, it appears to be incredibly prudent. I mean, if we compare with, say, the tech-focused NASDAQ, which even after it's, giving up its gains of last year, it's trading on double our portfolio rating. And yet our EBITDA is growing 50% faster than that of the NASDAQ. In addition to this, it's worth considering 4 hygiene factors when it comes to our valuation multiples. The first is that Oakley, and more importantly, the board of OCI, receive independent valuations to compare with those provided by the manager. So it has a sense check. The second point is that on average, since inception and through cycles, Oakley has sold investee companies at an average premium to book of 50%. And actually, if you look at the last kind of few years, with the likes of Tech Insights, WebPros, Inspired, that average has been a lot higher and more like 90, 100% premium. So hopefully providing even more confidence in the NAV that we provide you with today. And I think key to how we approach valuation is that those current multiples are not underpinned by listed peer groups. And there's two reasons for that. One is there aren't many listed peers for the companies in the portfolio. Take, for example, RU Group is a good example. They don't have a direct peer. There are some listed university groups, some in Latin America, some in Northern America. But in the main, whilst they are university groups, they are predominantly based on revenues generated by on-campus degree courses, not anywhere like the kind of business that RU Group is. So they're not driven by listed peers because there aren't any in many cases. And I think the other key thing is how we approach the valuation multiples. And it's this idea that essentially there are only really two times when you can be absolutely certain of a valuation multiple, in the private equity world at least, when you buy it and when you sell it. And we don't speculate on the likely exit value. What we know is the entry value. And as a result, prevailing multiples tend to track more closely the entry valuation. Now, of course, in time, as companies grow in scale, as they change the quality of earnings, as material events happen within the business, of course, you'll see appreciation in the valuation multiple, particularly as the way in which we were able to access companies in kind of off-market, often messy transactions. We get in at really interesting multiples, and it's hard to justify holding a large software business on the single-digit entry multiples that we held them on. But I think the point I wanted to make is our valuations shouldn't be volatile, and they shouldn't directly respond to the public market ratings. And finally, and apologies if this is obvious or is known to the majority of you, but it isn't known to those that don't invest in listed PE, is it's worth clarifying with a manager like Oakley, and is the case in general with true kind of private equity and buyout funds, there is no incentive for the manager to aggressively value the portfolio. It has no bearing on its management or performance fees. Oakley and those within it are only paid the latter performance fees at the point of realization. There is no unrealized gains that they benefit from kind of whatsoever. Let's look at the NAV breakdown. So taking a closer look at how that divides up. So based on December valuations, OCI currently has a look-through portfolio valued at £928 million. It has 163 million of cash at the period end, and both of these are offset by 130 million of liabilities, which are largely fund facilities within the Oakley funds. These three net off to provide you like 961 million of net asset value. And talking of the cash, this combined with the kind of expected near-term proceeds puts OCI in a very strong position to participate in future funds, Oakley fund performance. And to this end, OCI announced an initial €400 million, or as we have there on the screen in pounds, £336 million commitment to the new Fund 5. So you'll see there we have outstanding commitments of £740 million as it sits. It's very rare. In fact, in most cases, we only ever have to draw 50 to 60% of the commitment. And that's for a raft of reasons. You don't ever really truly fully deploy a fund. For a variety of reasons, it's very hard to get to exactly 90 or 100%. Secondly, there's recycling of cash. It doesn't always flow back down. You can recycle it back in, so you don't have to come up with new capital. And there's debt facilities which bridge investments as well, so we don't always have to call immediately for cash. So we anticipate that about 224 million is unlikely to be drawn of that 728. We then have the 163 million cash that currently sits on the balance sheet, and the uncovered 350 million pounds. We can confidently assert here that we expect that to arrive via proceeds in the next 12 to 24 months, and that is a particularly conservative timeframe. What underpins our confidence there? There's a number of things. One, it's the current and consistent engagement from interested parties in our existing portfolio. Two, it's the current age of the portfolio. So despite recent new investments, the average age of the holdings is still just over 3 years. And the average hold period of our realized assets to date is about 3.6 years. And today, about 7 of the investee companies have been held for more than 4 years. So hopefully demonstrating that we have a number of assets that are that are kind of relatively mature and should be in a position to be realized in the relative near term. Those kind of expected number of proceeds that we've mentioned there, and actually the number we expect is much larger than that, but we just focus on what's required to cover the commitments, is pretty much in line with past levels of proceeds. So within the last 2 years, we generated somewhere in the region of 460 million proceeds. And finally, as this week's Bain private equity report underlines, there is a record $1 trillion of dry powder sitting in buyout funds, particularly the large cap global funds, which I think bodes incredibly well for Oakley's kind of future exits. The assets that we touched on are split with 758 million held via the funds and 170 million of direct portfolio investments, which includes 123 million of North South debt and the residual being a direct equity stake in Time Out. Now, the board has confirmed that one, we have no intention of making further direct investments, and we intend to realise the direct positions that are currently outstanding within the next 12 to 24 months. I think importantly, whilst that is our stance, we won't be putting pressure to sell those assets in a way that disadvantages the kind of OCI shareholders who want to maximise the value of those two investments. Due to the impact of the pandemic, North South required additional support funding in 2021. It did also in 2020, and that wasn't the plan, but it was as a result of circumstances outside of our control. And largely that funding was to fund the losses within and working capital required within the apparel business. Really encouraging, we can report a really positive outlook for the company kind of going into this year. It's currently ahead of budget in all its divisions, all its 5 divisions, and is expecting to deliver an EBITDA this year 2.5 times greater than that in 2019. And then as a guide, roughly, we did about 10 million euros of EBITDA in 2019. Let's look at that equity exposure split by sector and company. And as you can see, it's pretty evenly split across our 3 focus sectors of technology, consumer, and education. And it's also reasonably evenly split by underlying companies. Particularly noteworthy is OCI's increasing relative exposure to IU Group, which is about circa 17%, or sorry, 14 to 15% of NAV, which remains one of the most exciting prospects in the portfolio as it moves from being a German-European opportunity to being a global one. Whilst we divide the investments into our 3 focus sectors, there is clear overlap between them, with 70% essentially qualifying as being technology due to them delivering their products or services digitally. And the majority of the remainder that currently sit outside the technology subset, we're exploring adoption of digital solutions as part of the investment thesis. If I take, for example, Dexter's, which for those in the southeast of England will recognise the kind of premium real estate agents, we invested in that space based upon our experience of kind of offline real estate platforms. We also like the fact that it has highly visible earnings, so 75% of its revenue is based on lettings, which is more stable and recurring, unlike kind of one-off housing transactions. But what particularly appealed to us was this was a business with a strong brand and a strong offline presence, but no online presence. And there was a real opportunity to introduce a digital solution, kind of a low-cost, light-touch solution for landlords. And we're very much in the process of integrating that as we speak. We often highlight this, but I think it's all the more important in uncertain times that 75% of the portfolio, or 17 of the 22 companies there in front of you, enjoy an increasing level of subscription-based or recurring revenues, with the visibility attracting increasing valuations as Tech Insights demonstrated. In the current climate, it's worth highlighting the kind of Western and Southern European focus of the portfolio. And based on our expertise and network, this will remain the fund's geographic footprint. I should note that, yes, we will all, based upon our expertise and our network, you're likely to see us in, kind of those certain countries, typically Iberia, Italy, Germany. We're not particularly geography-led. We're not sitting there thinking, now we need another investment in Germany. What we are is, primarily opportunity and sector-led, and look, because of, where our connections are, we tend to find those opportunities within the countries that we've previously invested in. As we look to the future, and I guess now, importantly for all of us as shareholders, consider the resilience of the current portfolio post-COVID and the face of global economic uncertainty. And we consider the ability for Oakley to repeatedly source new deals in spite of strong demand for its hot sectors. The next slides will attempt to outline the three key factors which continue to kind of define and deliver the performance which the Oakley funds are built upon. Firstly, Oakley will be absolutely sticking to its knitting with regard to its focus sectors that it knows and understands well. And importantly, within these sectors, we're investing behind irreversible long-term trends that are in their relative infancy. And as we outline here in technology, that's our business migration to the cloud, or in consumer, it's the shift to online, which has only just begun in sectors and geographies. I mean, one of the questions I was asked yesterday was, well, hang on a minute, haven't we shifted online as consumers? Well, yes, probably here in the UK, in some sectors, that shift is very mature. But there are certain sectors still untouched, and there are certain geographies where the internet penetration adoption of these solutions far lags the UK. One example I often quote, and forgive me if you've heard me say it before, but it's a great example of exactly what I'm trying to describe here, is that in the UK, 80% of car insurance is now arranged online. It's a mature market, it's an established market, and it's been growing like that and establishing itself for quite a number of years. In Italy, when we bought the number one price comparison website, Facile, it was 12% of car insurance is arranged online. Even after the pandemic, that number is 20%. There are still, modest internet penetration, and there's still consumer behavior that hasn't shifted yet. And that is just one, particular example. There are plenty more. And look, it's not just digital trends that we are investing behind, but for example, in education, that includes the kind of growing global demand for quality and accessible education from the kind of rising middle classes, not just here in Europe, but in the world. And I think what's kind of pleasing, and yes, it's, as we sit here in March, it's early stages, but we can report that the portfolio companies, thanks to these drivers, are very much trading in line with expectations. If there is one facet of Oakley's approach which has defined us since inception, most differentiates us as an investor, and is the key ingredient on how we unearth such attractive companies at attractive valuations, then it is our relationship-led approach to origination. That empathetic partnership style to kind of back supporting successful business founders has built us an enviable reputation and a network of entrepreneurs of proven talent, some of whom we've backed 3 or 4 times. I think most tellingly, between them, the network of some 25 plus individuals has committed themselves to the fund. So some 400 million euros of our funds has been committed by the entrepreneurs we back, which creates a great alignment of interest. Now, these kind of mid-market opportunities they help us unearth aren't straightforward. There may be a carve-out from a larger parent company, or a family-owned group with little management information, poor accounting, or a messy shareholder structure. Or it could just be there's a very short time frame in which we have to act. The key point is these deals are complex. They are not even barely close to being part of a competitive auction. And if you are equipped and inclined to navigate this complexity as Oakley is, then there is the opportunity to acquire these companies at really interesting multiples, in spite of growing competition for private assets. And look, that's demonstrated in that 9.4 times average entry multiple that we've had for the companies that we've bought since inception. I'll tell you more about some of the exciting new investments we've made, but first let's talk about what we do with those businesses once we've invested them, because the creation of value here isn't just we buy them cheap and we hope that maybe we sell them high. or that they operate, successfully in line with the market. We actually are driving that value, and that is the one single biggest advantage of buyout private equity. We are taking majority stakes so that we can have some control of the destiny of that business. And that is unlike not only other areas of private equity, but unlike most kind of equity investing across the piece. So the third pillar of the performance of Oakley's value creation is its value creation toolkit. We've outlined 4 of the strategies on this slide here that we are most prolific at. There are others, but these that we really feel that we kind of outperform on. And they enable us to drive value regardless of the economic cycle or the operating environment. In the interest in time, I'll highlight 2 of these. There's the second column there, digitization. So taking offline, as I mentioned, indexers or companies with an early stage digital solution and driving the growth of that channel. A really good example of this is Alessi. I mean, if you can achieve this within consumer, you can essentially achieve it anywhere. And Alessi, 100-year-old family-owned business. It's, for those unfamiliar with it, it's a kind of premium home designer homewares group. And when we made an investment in 2019, it was loss-making. It had very modest online sales, less than 5%. And thanks to a dysfunctional and third-party provided website, those online sales were unlikely to grow much higher than that level. 2 years later, and despite COVID and with an entirely new management team, sales are up over 50%. But just as importantly, after a full revamp of its digital channels and marketing, 30% of sales are now attributed to e-commerce. And the EBITDA this year, well, one, it's going to be making it, but it's set to exceed over 6 million euros of EBITDA. And the other value creator that I'll refer to on this page is the 4th on the slide, which is buy and build. Now, to date, we've made 40 platform new investments. They, between them, have made over 100 acquisitions. And there are plenty of current active roll-up strategies within the portfolio. They include the likes of e-commerce One, ICP Education, Contabo, Windstar, Ocean, and notably Grupo Primavera. Now, the group now has made 8 acquisitions, and in doing so, it's really fulfilling its mission to become Iberia's leading independent provider of business software, helping thousands of SMEs migrate to the cloud. And we know the kind of value that can be created by being the kind of national software as a service business champion. I mean, Visma is a case in point. But notably, those 8 acquisitions, although successful businesses in their own right, would have been subscale, single product, modestly profitable, and on their own, from a valuation perspective, would be, low single digit or high single digit or low double digit multiples. Combined, then I don't think I need to tell you what, kind of software businesses of scale, kind of dominating a particular region can attract. You only have to look at some of the software-dominated PE firms to know what their average multiples are for companies of that nature. And look, just to kind of maybe highlight or demonstrate some of the things I've just been discussing over the previous slide, I've put on here a value creation bridge, which shows you where value has been created since inception and for all realized investments. So you see the amount on the left we've invested, on the amount on the right is what we've realized from those companies. And in between, you see essentially where value has been created. I think most importantly, it comes from organic growth. That's, thanks to the quality of the management, the sector it's in, kind of the market performance, but also how we're helping, drive that business to perform better. And then it's M&A, as I mentioned, kind of key, driving 20%. And then there is a certain amount of multiple expansion, not just because we were able to, buy them cheaply and sell them higher, but because we are creating higher quality earnings, which attract a higher multiple expansion. I think notably, particularly for those that are interested in this, and is often associated with private equity, financial engineering and debt essentially plays a relatively small part in the creation of value. So I mentioned new investments in the period. We made 6 of them. And they were coming via the kind of typical origination methods that I described earlier. And most importantly, they lay the foundation for future growth. We talked about most of these at the half year, so I won't go through them all, but they include the likes of Idealista, which is Southern Europe's answer to Rightmove and Zoopla. And digital penetration amongst consumers in Italy and Spain, as I've touched on, is way lower than Northern Europe. Look, as an example, in the UK, 90%, 95% of agents will be signed up and using Rightmove, whereas in Spain it's more like 65%, and the average spend per agent is kind of a fraction of what it is here in the UK. It's an exciting growth opportunity and builds on our track record in digital marketplaces. And then there's ITP Education, a leading chain of premium UK nurseries. But I mention it because it really extends our breadth of education investments. One new investment worth highlighting, which we made in September, is founder-led CTAG. Now, the Spanish advertising technology business is the leader of contextual advertising. So what's contextual advertising? That essentially allows audiences of a website to be identified based on the content they're consuming. So basically, AI analysis tools analyze the kind of written word or the image or the videos that are being consumed. And with that knowledge, advertisers or advertising or marketing companies will know which of their brands and adverts are most suitable to show at any one time. So why is that important or appealing? It's down to the third-party cookies, which are disappearing kind of amid privacy concerns. And big brands are now having to prepare for a cookieless future. And that is why the likes of Adidas, Renault, Nestle, Microsoft, and Unilever, as examples, are all working with CTAG. And CTAG has already exceeded our expectations. I mean, it did throughout the whole of the kind of sales, the purchase process, and has since subsequently. Its sales grew over 80% in the last 12 months. And as we look to the start of this year, they're trending at between 90 and 100% of growth. And there is so much new markets for them to go after. They haven't really got a presence in the US, and they're starting to build that as we speak. So looking to the outlook and in conclusion, what gives us confidence in the performance of OCI in 2022 and beyond? It's 3 things. It's that earnings growth. With a digitally focused portfolio, it will continue to grow, benefiting from those accelerating megatrends. There's the cash and expected proceeds that leaves OCI well placed to meet its commitments to the Oakley funds as it makes new investments. And I think importantly, as shareholders, the one thing that kind of intermittently can drive value over the course of this year will be continued activity. And we see strong prospects for both investments and realizations. Notably, the next time you'll hear from us will be with our first published quarterly NAV, which hopefully are another catalyst for the performance of the shares, and that will be on the 27th of April. So that ends the formal part of our presentation, and will lead us on to the Q&A.
Stephen, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Just while Stephen takes a few moments to review those questions submitted today, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Stephen, as you can see, we've had a number of questions, as we always do. If I could ask you just to click on that Q&A tab, and just where appropriate to do so, read out the question and give your response. That'd be fantastic. Thank you.
Thank you for all those that submitted questions. I'll attempt to move through those in the time allowed to us, and apologies if some of these repeat themselves. Paul, you asked, given the insane discount to NAV, should buyback plans be bigger to capture the money on the table? I mean, look, we've announced a buyback program of £20 million. That doesn't have to be the end of that buyback program. That is enabling the cash that's currently available, because clearly the board of OCI is weighing up, what cash is required for the funds, what cash is likely to come in, and I think there's an initial comfortable position they have in which they are looking to buy £20 million back. I think that is a strong signal of the intent here to enhance shareholder value, to return cash when they have it, but more importantly shows a significant confidence in the NAV, and as you point out, in the particularly large discount it's trading at. It is by no means the end of this year's program, but I think it shows a strong start to it. Yusuf asks how a Tarmac market's trading. Being a public company, we can't provide too much information that isn't in the public domain, and it's worth noting that Time Out's half-year results will be published on, I think, the 31st of March. However, I think what can we say about them? One, they are growing in momentum as life returns to normal, and I think in maybe some of the European cities, particularly in Lisbon and not European but Dubai on this side of the world, then you have seen, as kind of travel and COVID restrictions have released and COVID numbers have died down, so we've seen the kind of performance returning to the kind of levels you might expect. I mean, Lisbon, pleasingly, in February was trading and had the footfall that it had at the same time pre the pandemic, which I think is particularly encouraging. There's slightly more disruption in the US, but the signs are encouraging of those sites returning to the levels that we saw historically. Yusuf asks, how will the fall in valuations of technology and technology-enabled businesses affect the valuation of portfolio companies? Will they stay at the same level or fall further by the end of June? Well, hopefully the slide in which I touched on this particular subject will have dealt with that, and that is really, to repeat myself on that subject, is really on the basis that we are not pegging our valuation to the public market. Now, it's not to say that there are some companies that don't have some direct peers, but we're certainly not taking the same valuation. There is a lot of fat between the values that prevail in the public market today versus our portfolio. And as I said earlier, you've got companies like IU Group, some of the biggest and highest performing in the portfolio, that do not have public market peers. You should expect a lot less volatility from our NAV, and we have every confidence in the companies continuing to grow. And as I've said earlier, it's less the multiple that's driving our NAV increase to give you that confidence, it's the earnings growth. Andy asks, how do you see the NAV gap closing? Will you introduce mechanisms to manage this? Look, there's lots of things we can do to continue to look to close the difference between the share price and the NAV per share. We announced a share buyback yesterday. That was a great way of attempting to do that, returning cash in that way, and hopefully signals to the market the confidence we have in the NAV. We'll move into quarterly NAV updates, in which we will fully revalue the portfolio every quarter, unlike I'm not certain of any of our peers that do that quite to that extent at this point. Our comms and communication will continue to increase. I mean, the number of attendees on the call today is testament to the fact of Oakley's or OCI's increasing following, and it is increasing year on year on year. And we're going to continue to push that and to grow the kind of following and understanding of Oakley, which I think will again help to kind of close that discount. And whilst we're all focused on it, and it could be really the cherry on the top of the performance for OCI, I would always kind of say it's the one thing we have far more control on at Oakley and OCI is the NAV. It's the portfolio companies. That's what we can drive. That's where we can create value. And that primarily is what will grow the shares. And I hope that, as we all hope, that the shares start to trade, at or beyond the NAV per share. But I have no guarantee over that. And even if it doesn't, we will drive shareholder value on the basis of that NAV growth. And look, if you look at the performances of the listed PE universe last year, which all performed well, there is not a lot of correlation between those performances and the discount. And look, I'm talking against our book here. We're sitting on a 30% discount, whatever it is, 25% discount. But at some point we won't, and we'll still be an attractive investment proposition as a result. Jason asks, with 55% of the companies valued in euros, what is your opinion of any negative drag on Europe's weakness from current events and how that may affect the exit value over the next 12 plus months? Can I explain the hedging in place across dollars and euros? So those FX splits, Jason, are essentially the cash we have and any that we have on balance sheet and any unhedged positions that we have. So that is the kind of unhedged exposure. Look, I'm not here. We're a euro-based fund with euro-based investors into the fund. There is the wrinkle here that we translate that back to pounds. I can't really comment on the strength or otherwise of the light strength or otherwise of the euro, but what effects we are also trading in the continent of Europe, and the UK will no doubt be influenced by what happens in Europe as well. So you wouldn't imagine something dramatically happening to UK that wasn't happening to Europe, such that you should see some stability there. As we know, interest rates will kind of play one of the biggest parts in potentially driving the performance of those currencies, and that really is also an unknown given the current environment. Michael asks, what is the exit strategy the fund typically takes for investments? So we typically look, any private equity fund tends to look to make investments over a 5-year period and harvest them over a 5. So at the max, there tends to be a kind of 5-year holding period. As I've mentioned before, on average, we've held companies between about 3 to 4 years. That tends to be the timeline. And within that timeline, we set out an investment thesis and targets for that business that we aim to have them meet. And at the point of meeting those, we believe there will be a range of interesting investment exit opportunities for those companies. In terms of who we may or may not sell to, that very much depends on the point in time. To date, and certainly for the last 5 years, the majority of our exits have been to much larger private equity sponsors. And that reflects the fact that we often do a lot of the heavy lifting in the lower mid-market, the mid-market space, to kind of put these deals together, to kind of navigate that complexity I referred to earlier, and create something of scale that then is ready to kind of go into the hands of the kind of larger global PE funds. And we have done a number of deals recently with the likes of EQT, who have bought our online marketplaces, or CVC, who've been buying into our tech kind of SaaS businesses. Jason asks, do you a number of potential exits during any 1 year that you might do in your plan, or is it too hard to estimate? We don't necessarily plan in a year we must do a certain amount of exits. It's entirely down to maximizing the value of any one company. Now, as I've intimated during the presentation, we think that a number of the companies are reaching the stage based upon performance, maturity of investment, or frankly, the interest we've received in them, that we think there's likely to be realizations this year. There's no benefit for me being a kind of hostage to fortune as to how many, but I think hopefully we're indicating a certain level of confidence. Jason asked, to try to reduce the current 24% discount with the 20 million buyback, in what time frame will this be done? Thanks. So Jason, I think the first thing is that we're doing a share buyback because this represents real value. We get as you pointed out, a 25% return for investing the shares now based upon where the NAV is. And we think that's an incredibly interesting opportunity to buy the share. We haven't set a timeline, we haven't set a discount limit, and there's no need to do both. But we will be, we now have the luxury of being in the market to pick up shares as and when we want. And look, who knows what the future holds over the kind of coming weeks. There'll no doubt be uncertainty and volatility, and that will provide us with kind of interesting opportunities for our buyback. The time it takes us to deploy that will entirely be based upon, kind of the availability of shares and the price they're available at. Edward asks, are there any companies in the portfolio that are expected to go to IPO in the next 12 to 24 months? We don't tend to target IPOs. Generally, they take time. You don't get price discovery. There's volatility in the public markets, and the IPO windows frequently kind of open or close without much warning. And as we've seen, it's been one of the lowest kind of periods for new money raised by IPOs for kind of some years. There are companies which there has been discussions around an IPO based upon kind of public market demand for those. We may or may not explore that in the coming 12 to 24 months, but it certainly isn't our kind of primary exit route. Alan asks, can you give a bit more colour on the timing of the realisation of the 2 direct investments? I think when it comes to time out as a public market, there's no value in us, kind of disclosing our plan there. I think what I'd like to reiterate is that we won't sell anything until it reflects the value that we deem it should. And at the moment, given the prospects of the existing time out market portfolio and the prospects for signing new markets, plus you've got essentially a media business which is still kind of recovering from the pandemic, a new senior management team, there is a lot of value that's currently not reflected in those shares, as it sits on a market cap of circa 170 million. So we, as with significant presence on the board, will look to drive value over the next 12 to 24 months, and only then, and when it's recognised, we might have to kind of take certain corporate actions. Only then will we consider kind of liquidating some or all or any of that position. North actually, it depends on a number of things. North itself is now a large kind of profitable business, but at the moment it's actually structurally quite separated, and there are a number of restrictions in bringing it together. What we hope over the next year is that we can combine the structures of North, we can bring its balance sheet together, we can refinance the group, and we've had a number of approaches from particularly external investors wishing to invest behind North and potentially bring it together some other businesses. So I would like to believe that we'll have clarity on that, if not have executed it, then the next time we talk at the half year results in September. I don't have the exact timing of that runway, but it'd be more in that kind of timeline. Simon asks, have any of the founders you mentioned been tempted to invest in OCI rather than directing the funds, and if not, why? So yes, some of the founders that are invested. Well, I think some of the business founders that invest in the companies, some of the LPs that are invested in the funds, i.e. the big institutions invested into the funds, some of the Oakley staff and the board members have all own shares in OCI. And the final question, Simon asks, has the manager been growing its resources as outside this new fund? And absolutely. One of the challenges we have kind of post-COVID is we don't fit back in our office. We've probably grown by about 50% over the last 2 years. The investment team's grown to about 35 strong, and the supporting operations team behind them has grown to about 37. So if you think about that in terms of one, the growth in those numbers, that 50% growth is material, but also kind of reflects the fact that the size of the next fund, but also the kind of manpower that is required to kind of manage funds like these, incredibly different to kind of public market management, where a small, relatively small teams can manage the kind of sums under management that we might have here. Thank you very much for those.
And Stephen, as always, you've answered every single question, so thank you so much. I'm sure that is very well welcomed by the investors on the call today. And if there's any further questions that do come through, Stephen will have the ability to review those, and we'll publish them back out on the Investor Meet Company platform. Stephen, perhaps before we just redirect investors to give you some feedback, which I know is particularly important to you, I could just ask you just for a few closing comments, please.
Thanks. I mean, you've heard a number of summaries from me on why we feel confident about the kind of year ahead, but I think it's kind of more of the same for us. I think we remain confident in our company's abilities to grow, and they've already been showing that for us at the start of the year. We obviously recognise that there is a lot of volatility, market uncertainty, and no one's going to, or increasing inflation rate, no one's going to be unscathed by that, kind of anywhere in the world. But I think when you're investing behind these kind of irreversible kind of megatrends that we're pretty certain that those will provide, kind of a very strong driver in spite of the economic environment. I think the other thing that I think most interests people is around those activity levels, and hopefully we demonstrated that we have, significantly strong prospects for both investments and realizations.
Stephen, thank you indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order Stephen and the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of Stephen and the management team of OAKLEY Capital Investments Limited, I'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.